There's a particular kind of silence that precedes a seismic shift in markets, not the silence of calm, but the silence of a world that hasn't yet connected the dots sitting in plain sight. We are living inside that silence right now. And today, on the morning of April 14th, 2026, with silver trading at $74.07 per ounce, following a sharp 2.4% decline driven by the collapse of the Islamabad peace talks and the U.S. Navy's blockade of the Strait of Hormuz, I want to talk to you about a number that the mainstream financial press has not yet connected to the silver chart you are staring at this morning. That number is 1, not 100, not 1,000. 1. 1 kilogram of silver per electric vehicle, per battery pack, buried inside a corporate technical disclosure that most financial analysts skimmed past without pausing on the arithmetic hiding in plain view. Before you assume that is a misreading, consider what Samsung SDI has actually documented. Their all-solid-state battery architecture, built around a silver carbon composite anode layer that is precisely 5 micrometers thin, requires up to 5 grams of silver per individual battery cell. A standard 100 kilowatt-hour electric vehicle battery pack runs approximately 200 of those cells. The mathematics requires no doctorate to execute. 5 grams multiplied by 200 cells yields 1,000 grams, which is, by any scale you care to apply, exactly 1 kilogram of silver sitting inside every single vehicle built on this platform. Now contrast that with a conventional lithium-ion electric vehicle battery of today, which contains somewhere between 20 and 50 grams of silver, primarily distributed through its electronic control systems and connectors. What Samsung has done, quietly, in the language of engineering disclosures and partnership agreements, is engineer a 50-fold increase in the silver content of an electric vehicle, not a 5% improvement, and not a marginal incremental efficiency gain, 50 times the silver per vehicle, per car rolling off an assembly line. This is not vapor. Samsung SDI has a binding mass production agreement with Toyota targeting the 2027 model year, with Lexus vehicles scheduled as the inaugural commercial deployment. BMW has entered an active validation partnership with Samsung and Solid Power, with next-generation evaluation vehicles expected to incorporate these solid-state cells by late 2026. Pilot production lines have been operational since the third quarter of 2024. Field tests conducted across temperature extremes from -30 to +60 degrees Celsius have confirmed less than 5% capacity degradation after 500 charge cycles. This battery delivers a 600-mile range on a single charge. It reaches 80% capacity in 9 minutes. It carries a rated operational lifespan of 20 years. And Samsung won the Best of Innovation Award at CES 2026 for this technology, publicly confirmed by CEO Yoonho Choi as being in preparations for mass production that are, in his own words, well underway. Now do the demand mathematics, because this is where the story transforms from merely interesting into genuinely alarming. Global electric vehicle production crossed 20 million units in 2025, according to International Energy Agency data. If just 20% of that segment, 1 in every 5 electric vehicles, adopts Samsung's silver carbon architecture by 2028, the additional annual silver demand from that single application reaches approximately 16,000 metric tons per year. Convert that figure into troy ounces, the unit the silver market speaks in, and you arrive at roughly 514 million ounces of additional annual demand. That is approximately 62% of total current global mine production, from one technology, from one battery chemistry, from one conservative 20% adoption scenario, and the silver chart on the morning of April 14th, 2026, has priced in precisely 0% of that demand curve. To understand why this matters so profoundly, you must first understand the condition the silver market is already in before Samsung's math enters the equation. The silver market is not approaching this technological inflection from a position of comfortable surplus. It is entering it from 6 consecutive years of structural deficit. The Silver Institute projected, in its pre-survey commentary published in February 2026, a 6th consecutive annual silver supply deficit of approximately 67 million ounces for this year, stacked on top of roughly 95 million ounces of deficit recorded in 2025 alone. The cumulative 5-year structural shortfall has already exceeded 800 million ounces. That is the equivalent of an entire calendar year of global mine production simply consumed into above-ground inventory drawdown. The world has been spending its silver savings account for half a decade, and the exchange warehouses that are supposed to backstop the paper market are now reflecting this reality in terms that anyone with access to a spreadsheet can verify. COMEX registered silver inventory, the metal sitting under delivery warrant, immediately available for contract settlement, stood at approximately 76 million ounces as of late March 2026. Against total silver futures, open interest of approximately 576 million ounces, that produces a coverage ratio of just 13.4%. Read that figure carefully. For every 100 ounces of silver that has been promised on paper through COMEX futures contracts, only 13.4 ounces of real, physical, deliverable silver exists inside the exchange warehouse system. The remaining 86.6 ounces run on an assumption, the assumption that most contract holders will never actually demand the metal. That assumption is now being stress tested in ways the exchange operators did not publicly anticipate. In the first week of January alone, COMEX warehouses saw 33.45 million ounces withdrawn in just 7 days, 26% of registered inventory gone in a single week. February 2026 saw the highest delivery volume in modern COMEX history. Meanwhile, something else is happening in the Eastern Hemisphere that the Western paper market has chosen, rather remarkably, not to price. The Shanghai Gold Exchange's silver fix on April 3, 2026, printed in a range of approximately $80 to $81 per ounce, while COMEX was trading near $73 that same day. That is a 10 to 12% premium for physical silver in Asia over Western paper prices. China's silver imports in just the first 2 months of 2026 reached 206.76 metric tons, the highest level in 8 years. Asian Silver Exchange traded products added 10.4 million ounces in a single week from April 3rd to April 10th, while North American Exchange traded products were net sellers. The metal is flowing east. It is not flowing back. And as of this morning, physical silver in Asian markets is commanding premiums above the COMEX paper price, a spread that is not narrowing but persisting. The screen in New York and the physical reality in Shanghai are telling two different stories, and one of them is correct. Now, if you have been watching silver, following the fundamentals, trying to make sense of a market that hit an all-time record of 121.67 on January 29th of this year before collapsing more than 40% to below $68 by early March, only to claw its way back towards $75 before today's pullback, you know that this market does not move in polite, orderly increments. It moves in violent surges and equally violent corrections. The Bank for International Settlements classified that January spike as speculative excess, driven by a paper-to-physical leverage ratio of approximately 21 to 1. When that leverage unwinds, as we saw in February and March, it does not unwind gently. It does not respect chart levels or long-term holders, or even the underlying supply-demand mathematics that would, in any rational market, prevent a 40% crash in a commodity already running a 6-year supply deficit. But here is what that crash could not erase: the Samsung number, the COMEX coverage ratio, the Asian physical premium, and the 6 consecutive years of deficit. Those facts did not change in the sell-off. They were simply temporarily overwhelmed by margin calls and speculative liquidation. If you are watching this for the first time, if you stumbled onto this channel because a friend shared it, because the title caught your eye, because you are sitting on a position in silver and trying to understand what you actually own, I need you to subscribe right now and ring that notification bell, because what I am about to walk you through in part 2 is the part that even most silver bulls have not fully assembled. We are going to look at the supply side of this equation, the side that makes the Samsung demand curve not just compelling, but structurally transformative in a way the mining industry is physically incapable of matching on any reasonable timeline. The supply response to this demand shock cannot happen the way it happens in most commodity markets, and the reason why is embedded in a geological and industrial reality that is as fixed and immovable as the periodic table itself. Stay with me. There is a counter-argument that emerges with predictable regularity every time the silver demand thesis reaches a compelling crescendo, and it is the counter-argument of the perpetually skeptical. Mining supply will respond, prices will rise, miners will dig, the market will balance, and the doomsday arithmetic will dissolve back into the comfortable equilibrium that commodity markets have historically demonstrated over long enough time horizons. It is a reasonable argument. It has the comforting weight of economic first principles behind it, and in the case of silver, it is almost entirely wrong, not because the laws of supply and demand have been suspended, but because of a geological and industrial reality that fundamentally severs the connection between silver prices and silver production in ways that most investors have never examined closely enough to understand. Silver is not primarily mined for silver. That statement deserves to be read twice, because it is the fact that breaks the standard commodity supply response model. Approximately 72% of global silver production comes not from silver mines, but as a byproduct of copper mining, lead mining, zinc mining, and gold mining. Silver rides out of the earth on the coattails of other metals whose prices and demand cycles are entirely independent of the silver market. When the silver price rises, the world does not simply open more silver mines. It opens more copper mines, because copper demand is driven by construction and infrastructure. It opens more gold mines, because gold demand is driven by monetary policy and safe haven flows. Silver comes out the other side as a byproduct, and the decision to expand that production is made for reasons that have nothing whatsoever to do with silver's supply deficit. The silver market cannot pull its own supply lever. It borrows one that belongs to an entirely different set of commodities. New primary silver discoveries, mines that exist specifically because silver is the primary economic metal in the deposit, are becoming rarer and require longer lead times to bring into production. Existing primary silver mines are depleting. Global mine production has been running at roughly 820 to 850 million ounces annually, and the Silver Institute projects that figure staying essentially flat or declining slightly even as demand continues to structurally expand. The supply side of this market has no surge capacity. It has no reserve battalion waiting to be deployed when the demand curve shifts. What you see is, broadly speaking, what you get. And right now, what you are getting is less. Mexico produces approximately 200 million ounces of silver annually, roughly 23% of total global mine supply. In the first week of April 2026, the two largest Mexican silver producers began removing ounces from the 2026 production calendar. Fresnillo, the world's largest primary silver producer, cut its 2026 output guidance to a range of 42 to 46.5 million ounces, down from a prior forecast of 45 to 51 million ounces. First Majestic followed days later with its own downward revision. These companies are not expanding into rising prices, they are contracting. And that contraction is happening before the resolution of a Section 301 tariff investigation into Mexican silver imports that, if it results in a 10% tariff, would effectively remove one of the world's primary silver sources from competitive access to the world's largest paper futures market. In a market already running a 67 million ounce annual deficit, that is not a footnote. That is a crisis accelerant arriving at precisely the wrong moment. Now, let us talk about the money that already knows this. Because this is the part that should genuinely disturb anyone who follows institutional research and then looks at the current $74 screen price and wonders how those two things can simultaneously exist in the same reality. Bank of America's head of metals research, Michael Widmer, has published a 2026 silver price target range of $135 to $309 per ounce. That is not a typo. The $135 figure is anchored in the 2011 gold to silver ratio low of 32 to 1. Applied to current gold prices near $4,650 per ounce. The $309 figure applies the 1980 Hunt Brothers extreme ratio of 14 to 1. Both numbers are built from documented historical precedent in ratio mathematics, not from speculative enthusiasm. Citigroup has set a target range of $150 to $170 for physical silver based on shortage conditions. Goldman Sachs has projected a 2026 average of $85 to $100 per ounce and has labeled silver the primary strategic metal of the green transition in published research. The Reuters analyst poll now projects a 2026 average of $79.50, a figure that was $50 just 6 months ago in October 2025, a 59% upward revision in the consensus view in half a year. And not a single mainstream financial television anchor has connected that repricing to the Samsung battery filing sitting in the public record. Goldman Sachs has also published a specific warning about the Chinese silver export licensing framework, which restricts exports to 44 government-approved companies, each required to hold at least 80 tons of annual refined output and credit lines above $30 million. This framework has, in Goldman's assessment, structurally fragmented the global silver market from a pooled, interconnected global system into isolated regional inventories that are prone to sharp, localized price spikes when demand concentrates in any single geography. That is not a retail silver blogger's observation. That is the largest investment bank in the world describing a market structure that makes the Samsung demand math exponentially more dangerous when it activates. When 20% of global EV production begins requiring 1 kilogram of silver per vehicle, it will not be drawing from a single unified global silver pool. It will be competing with other industrial consumers in a fragmented, regionalized market where Chinese export controls and Western tariff regimes have constructed walls between supply and demand that did not exist 5 years ago. The London Silver 1-month lease rate, the borrowing cost for physical silver in the largest over-the-counter precious metals market in the world, currently sits at approximately 5%. The historical norm is below 1%. The market is paying 5 times the normal cost to borrow physical silver more than 6 months after the original liquidity spike that drove lease rates to 39% in October 2025, then respiked to 8% during the January 2026 delivery cycle. Lease rates at this level are not a sign of normal market functioning temporarily disrupted by a speculative episode. They are a sign of structural tightness in physical availability that has not been resolved by the price correction. The paper price collapsed 40%. The lease rate remains 5 times normal. Those two data points, read together, tell you that the paper market and the physical market are increasingly disconnected. And when physical markets send signals the paper price refuses to hear, the physical market has historically been the one telling the truth. This is the moment where I must insist that you do something specific. If this video is changing how you see the silver market, if the Samsung arithmetic, the COMEX coverage ratio, the institutional price targets, and the Mexican supply contractions are assembling into a picture that your previous silver research had not fully constructed, then share this video with one person right now. Not because this channel needs the views, but because the person you are thinking of, the one who looked at silver's 40% crash from $121 to under $68 and concluded the bull market was over, deserves to see the supply-demand reality that the price correction did not change. Markets correct, supply-demand mathematics does not. The arithmetic of 514 million ounces of potential annual demand arriving into a market already running a 67 million ounce annual deficit was true when silver was at $121 in January, true when it was at $68 in March, true when it bounced towards $75 last week, and true at $74.07 this morning. Price is temporary, math is permanent, but I owe you the other side of this argument, the honest, complete, unvarnished countercase, because anyone who presents the silver thesis without it is not giving you information. They are giving you advocacy. And part 3 is where we do the work that separates genuine analysis from enthusiasm dressed up in data. Intellectual honesty demands that we treat the bearish case for silver with the same rigor we have applied to the bullish one, because the bearish case is not simply a collection of timid objections from people who lack courage. It contains real structural risks that could materially alter the trajectory the demand mathematics would otherwise suggest. Let us examine them without flinching, and then let us assess what the evidence, in total, actually supports. The first serious risk is substitution. The Silver Institute itself is forecasting industrial fabrication demand declining 2% to a 4-year low of 650 million ounces in 2026. The primary driver of that decline is the photovoltaic sector's ongoing, aggressive campaign to reduce silver content per solar cell in defense of margins. LONGi Green Energy, the world's largest solar panel manufacturer, formally announced it will begin mass production of copper-based solar cells in the second quarter of 2026, representing the first credible, scaled substitution threat to silver's dominant position in solar manufacturing in more than a decade. If the solar sector continues to move away from silver at scale, one of the largest and most established industrial demand pillars weakens precisely as the Samsung demand curve is supposed to be building. Demand does not simply aggregate, it competes with itself, and thrifting in one application can partially offset expansion in another. The second structural risk is competing battery technology. Stellantis and Massachusetts-based Factorial Energy have validated a semi-solid state battery architecture at 375 watt-hours per kilogram that does not employ the silver carbon anode design. That platform is scheduled for demonstration fleet testing in late 2026. QuantumScape, backed by Volkswagen, continues development of a solid-state architecture that similarly does not incorporate silver at meaningful scale. If any of these alternative platforms scales into commercial production in the 2027 to 2029 window that Samsung is targeting, the silver demand curve I have described does not materialize on the timeline that the current market pricing requires. The 514 million ounce demand figure is real arithmetic, but it is conditional arithmetic. It requires Samsung's specific silver carbon architecture to win the commercial solid-state battery race, not merely to participate in it. That outcome is probable based on Samsung's pilot line operational status and Toyota binding agreement, but it is not guaranteed, and the distinction matters. The third risk is one that silver investors experienced in the most visceral terms imaginable just weeks ago. Silver demonstrated between January 29th and early March that it can lose 40% of its value in a matter of weeks. The Bank for International Settlements identified that crash as the unwinding of a leverage structure estimated at 21 paper ounces claimed for every 1 physical ounce of deliverable metal. CME Group margin hikes accelerated the forced liquidation. A hawkish revision in the Federal Reserve's dot plot from 2 projected 2026 cuts to 1 removed a critical pillar of the monetary support narrative. A strengthening dollar provided headwinds. Hedge fund liquidation cascades did the rest. Not a single one of the supply-demand fundamentals we have discussed changed during that crash. The coverage ratio was still 13.4%. The annual deficit was still projected at 67 million ounces. The Samsung agreement with Toyota was still signed. None of it prevented a 40% price collapse in 6 weeks. Leverage unwinds are not respecters of fundamentals, and any honest silver analysis must account for the reality that the paper market can, for extended and painful periods, diverge from physical market reality without any mechanism to force immediate reconciliation. The fourth risk, and the one most immediately relevant to today's $74.07 price, is geopolitical. Silver has sold off sharply this morning specifically because the Islamabad peace talks between the United States and Iran collapsed over the weekend, the U.S. Navy has prepared a blockade of the Strait of Hormuz, and Brent crude has jumped more than 7% above $102 per barrel. When energy prices spike, inflationary expectations rise, and the Federal Reserve's rate cut path closes, the opportunity cost of holding non-yielding assets like silver increases. The dollar strengthens as the preferred safe haven. Capital that was flowing into precious metals flows instead into the currency. If, and it is a meaningful if, a diplomatic resolution emerges and the Strait of Hormuz fully reopens, the geopolitical bid under precious metals could evaporate in a single trading session. Silver is not simply a supply-demand story. It is simultaneously an industrial metal, a monetary metal, a geopolitical risk barometer, and a speculative vehicle for leveraged traders. All of those identities can conflict with each other at any given moment, and the one that dominates price action is not always the one that the fundamentals would select. Now, having laid that honest accounting before you, let us step back and look at the complete picture, because the sum of the evidence, including the risks, still tells a coherent and remarkable story. The silver market entered 2026 with 6 consecutive years of structural deficit. It then experienced an all-time price record of $121.67 on January 29th, followed by a 40% crash to below $68, followed by a partial recovery towards $75, followed by today's pullback to $74.07. In the middle of all of that volatility, COMEX registered silver inventory coverage remains at 13.4%, stress territory by any historical measure. Asian physical silver markets are paying persistent premiums above Western paper prices. London lease rates remain 5 times their historical norm. Bank of America has published a $135 to $309 price target. Goldman Sachs calls silver the primary strategic metal of the green transition. The Reuters consensus repriced its 2026 average projection by 59% in 6 months. And Samsung SDI has a signed, documented, pilot line operational binding agreement with Toyota to begin mass production in 2027 of a battery architecture that requires 1 kilogram of silver per vehicle, 50 times the silver content of a conventional electric vehicle battery. The gap between $74 and where the fundamentals are pointing is not manufactured suspense. It is the documented distance between where the paper screen is priced today and where the supply-demand mathematics is heading as the Samsung production agreement moves from signed document to operational assembly line. Markets do not price in demand that has not yet materialized. They price in the present, but the present has a habit of becoming the future, and futures have a habit of eventually reaching the price that the mathematics specified in advance. What you do with that information belongs entirely to you. Your risk tolerance is your own. Your time horizon is your own. Your financial position is your own. The honest question, the one this data demands you sit with, is not whether the Samsung math is real. It is documented engineering arithmetic. It is not whether the supply deficit is real. It is in the Silver Institute's published research. The honest question is, how much of this 514 million ounce potential demand curve has the market priced in as of this morning's $74.07? The answer, as best as the available evidence allows one to calculate, is approximately 0. That is not an invitation to act rashly. It is an observation about where the screen stands relative to where the fundamentals are traveling. The World Silver Survey for 2026 releases tomorrow, April 15th. I will be back at this desk within hours of that publication to walk through every line of the supply and demand tables before the mainstream financial press figures out what the 6th consecutive annual deficit number means alongside the Samsung production timeline. If you want that analysis the moment it is available, subscribe and ring the notification bell now. Not as a ritual, but because the window between when data is published and when it is fully priced by a market moving at the speed of institutional computers is measured in hours, not days. And if this script of data and arithmetic has landed differently than your last silver video, if the Samsung number, the COMEX coverage ratio, the Bank of America targets, and the 6-year deficit picture assembled into something that you had not previously seen clearly, drop a comment below and tell me exactly which piece of this puzzle hit you hardest. Was it the 50 times silver content comparison? Was it the 13.4% COMEX coverage ratio? Was it Bank of America publishing a $309 target while the screen sits at 74? Tell me in the comments, because the conversation that happens below this video is often sharper than the video itself, and the community that is built around this kind of rigorous, data-grounded precious metals analysis deserves to hear what you are thinking. One final thought. The silver chart this morning shows 74.07. 18 months ago, it showed $30. 12 months ago, it showed approximately $28 to $30. 6 months ago, it reached $121.67 before correcting violently. Today, it sits at $74.07. Down 2.4% on the back of failed diplomacy and a naval blockade of the Strait of Hormuz. All of that price history, all of that volatility, all of those crashes and surges happened before the Samsung battery architecture entered mass production, before a single Lexus with a solid-state battery rolled off a Toyota assembly line, before the first kilogram of Samsung's silver carbon battery demand hit the physical market. The question the market has not yet answered, the one sitting quietly inside the gap between $74 and every institutional price target published in 2026, is what happens to this already deficit, already squeezed, already fragmented global silver market when it does. You already did the math. 5 grams per cell, 200 cells per pack, 1,000 grams, 50 times the silver, 20% adoption, 514 million ounces, 62% of global mine production, from one technology, from one chemistry, from one signed agreement between Samsung and Toyota, in a market that has run a 6-year supply deficit and sits at 13.4% COMEX coverage. The screen always catches up with the mathematics. It just never announces exactly when. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.